In this video, I want to continue my economic predictions for 2024, which means we will be covering wages, the real estate market, the car market, the stock market, and the bond market. Now, I must preface this video by saying I do have my degree in finance and I love looking at the data into these things, but there are people way smarter than me with access to way more data who still get this wrong every single year. So please use this video plus many other videos and many other resources to come to your own conclusions about what might happen economically in 2024. With that out of the way, let's get started. So starting with wages. I think wages will continue to rise steadily, but it will not be exponential. And unfortunately, just like in 2023, people will still have a feeling of being underpaid. This primarily has to do with the high prices that we're dealing with because of the high inflation that we've experienced over the last couple of years. Now, wages are finally outpacing inflation. But with that said, it'll still take a couple of years for wages to catch up and overtake all the damage that inflation has done since 2020. So while I don't think anything major will change in 2024, I am much more hopeful for 2025 and 2026. Although obviously it's much harder to predict the further in the future we look. Okay, now let's move to real estate. This is a big one, especially if you haven't bought a house yet, because right now we are in the middle of a housing affordability crisis. And as painful as this is going to sound, I don't think real estate is going to crash in 2024. And this simply has to do with supply and demand. You need many, many more sellers than buyers in order for a crash to happen. And when you look at the data, there are currently less sellers now than pre-affordability crisis in 2019. So if we didn't have a crash in 2019, it's going to be hard to have a crash now with many less sellers. In fact, in order to have a crash or a drastic reduction in real estate prices, you need many millions of sellers to come on the market. And you can do that by looking at this chart, which shows you how many sellers were on market during the Great Recession. Now, luckily, that doesn't mean that I think prices are going to shoot to the moon. Although for most people, they're already on the moon. Prices are probably going to remain steady or slightly increase through 2024. And this has to do with interest rates. You see, a lot of people think that as interest rates come down, housing affordability will get better. The problem is that in the economy, every action has a reaction on both sides, the supply and the demand side. And yes, as interest rates come down, housing should become more affordable. But that also means that demand might skyrocket. In fact, a recent study shows that for every percentage drop in mortgage rates, about 3 million new potential homebuyers can afford the median priced home. So it becomes a question of whether this drop in interest rates will affect supply or demand more, because it will affect the supply side as well. It will make construction loans less expensive for builders, which hopefully will spur new growth in the starter home market. Right now, builders are focusing on middle to higher end homes simply because by adding cheap square footage like larger living rooms, they can charge more for a house and make more of a profit or cover more of their expenses. So as interest rates come down, hopefully more builders will start to focus on starter homes as they become more profitable for them. Lower interest rates also affects supply in one other major way, and that is with potential sellers who are currently rate locked. You see, right now, the people who bought houses, say 2, 3, 4 years ago have a very low mortgage rate, which means that if they want to purchase a new house or move, interest rates are so much higher that they can afford less house, not more, for the same payment. And most people who want to sell want to either move upmarket or get a bigger house as their family grows. Those sellers specifically are rate locked currently because they literally cannot sell and afford a better house because of mortgage rates. So hopefully as rates fall, those sellers will come on market. So it really becomes a question of whether mortgage rates will affect the supply side or the demand side more. And in my opinion, unfortunately, it will probably affect the demand side slightly more, which will cause price stability or a slight increase in real estate prices. I know, not the news you probably wanted to hear, especially if you haven't bought a house yet, but I do have a consolation prize for you. And that deals with the second most expensive purchase that most people buy after houses. And that is cars and the car market. Luckily, there is better news to report for the car market. And my predictions for 2024 is that prices of virtually all vehicles will continue to fall. And electric vehicles will be hit particularly hard. This has to do with manufacturers making a ton of them expecting high demand, when in reality, demand has actually been quite mild. So again, supply and demand, and in the car market right now, it is oversupplied, which means that leasing, buying, and financing outright should all become more affordable as we progress through the year. You can expect higher incentive packages, and you can expect more ability to negotiate, as well as the return to below MSRP selling prices. And on top of all of that, I do predict that there will be an end to markups on all but the most sought after vehicles. So if you're looking to buy a car, 2024 should be a good year for you. And if you've been holding out, your patience will probably pay off. Okay, now let's move to the investing side of things. What's going to happen to the stock market in 2024? Well, barring a major recession, I think stocks will finish at new highs. Although I do think it'll probably be a pretty mild returning year, so don't expect like 30 or 40% out of the general S&P 500. Now, why do I think that stocks will finish the year higher? Well, again, like most things recently, it has to do with interest rates. As the Federal Reserve cuts the federal funds rate, safer assets like bonds and high-yield savings accounts and the high returns that they are offering will slowly start to diminish. Right now, you can stick your money in a high-yield savings account and get 4 or 4.5% return. As those go away, the money that has been pulled out of the stock market and funneled into those assets will return to the stock market. Hence, more demand for the same amount of supply, all things being equal, should send prices higher. On top of that, lower interest rates also help stocks in one other major way. Remember, stocks are just ownership in companies. And as interest rates fall, those companies behind your favorite stocks will have cheaper access to capital, which means lower costs for research and development, lower costs for building new factories, and lower costs for loans to create more products. A general rule of thumb, all else being equal, is that higher interest rates are bad for the stock market and lower interest rates are good for the stock market. And because of this, as long as we don't have a major recession, the lower federal funds rate that is almost guaranteed will positively affect the stock market. Alright, now we have to talk about the bond market. I know it's not as popular, but it is still a very important piece to the investing puzzle. And I think there's good news for bonds as well. I think bond prices will finally see some relief as rates are cut. Remember that bond prices and interest rates are inversely correlated. And this simply has to do with the fact that a bond has a fixed payout. Yet the yield of the bond rises and falls with interest rates. So if a bond has a fixed payout and the yield has to rise as interest rates rise, the only way for that to happen is for bond prices to fall, which is what we've been experiencing in the bond market for the last year or so. So as interest rates are cut, those fixed payments are allowed to become a smaller percentage of the bond's overall price. An easier way to think about this, $1 is a higher percentage of $10 than it is of $100. And if $1 is the bond's fixed payout, then as interest rates rise, the bond price has to fall. And as interest rates are cut, that bond price can rise. And as long as the Federal Reserve does stick to its forecast of 3 rate cuts, all else being equal is good news for the bond market. So to recap, I think wages will steadily increase, but it will not be anything exponential, and unfortunately people will still feel underpaid in 2024. I think real estate prices are going to remain steady or slightly increase. Unfortunately, especially for those who haven't purchased a home yet, I don't think we're going to see a drastic reduction in real estate prices. Although on the other hand, I do think that the car market will get better for buyers as prices for virtually all vehicles continue to fall, and one can expect higher incentive packages below MSRP prices and an easier ability to negotiate with dealerships. In regard to the stock market, again, all else being equal, I think stocks will finish higher, and that has to do with reduction in interest rates, and I also think that bond prices will rise once again because of a reduction in interest rates. So we will see a similar theme in 2024 that we saw in 2023, and that is that most economic activity, both positive or negative, will be heavily reliant on what the Federal Reserve does. Now, talking about what the Federal Reserve does, if you haven't seen part 1 of this video, please feel free to check it out in the description below. In that video, we talk about interest rates, inflation, the job market, the soft landing potential, the potential recession, and financial stability. Other than that, I hope this video was helpful and informative, but please do your own due diligence when it comes to coming to conclusions on what will happen economically. If you like personal finance, world economics, and things like this broken down simply, you are in the right place. So please consider subscribing if you haven't already. This is a relatively new YouTube channel and it helps us tremendously. This is something that I love and I want to be able to share with you guys for many years to come. And don't forget to turn on the bell notifications so you don't miss the next video. New videos usually come out on Tuesdays, but sometimes I'll do a video Wednesday, Thursday, or Friday if something like a Federal Reserve meeting happens, an interest rate change happens, or some major thing about the economy that needs to be shared with you guys. I will do my best to bring it to your attention as quickly as I can. Other than that, I hope you have a fantastic weekend and I hope that you're having a great start to the new year. I'll see you in the next video. Take care.